Private loans are intended to be short-term. Both the lender and borrower have the incentive to get out of that loan on or before maturity, right? So that being said, things always happen and this isn't always a reality. And we understand that as well. But when it does, we'll typically charge those extension fees, but this is always going to be flexible and always going to be on a case-by-case basis with depending on the borrower situation.
Hey everyone, thanks for tuning into the Canadian Private Lenders Podcast, a show covering the private lending industry, the mortgage broker space, and the Canadian economy. Your hosts are Neil Andrino and Ryan McNeil. Enjoy.
All right, everybody, welcome back. It's episode 77 of the Canadian Private Lenders Podcast. You've got solo host Ryan today. Neil's at a previous commitment. And as mentioned on the last episode, we're going to talk today about what happens at the maturity of a private mortgage. Okay, so very important question to consider when you have your clients or yourself looking at a private mortgage. As we've discussed many times, this is always intended to be short-term, 6, 12, 24 months at the maximum. And you really need to know what's that exit strategy going to be, okay? But of course, oftentimes, and we'll get into this, exit strategies don't always play out as expected. So the question that many people ask, or should ask at least, is what would happen if I'm not able to pay out this loan at maturity, okay? So thanks for tuning in today. As mentioned, we're going to talk about why this maturity process is crucial for whether you're a borrower, a broker, or an investor. And we're going to cover many different things here. We're going to do a quick overview of renewals. We're going to talk about repayments or potential default consequences in tougher situations, okay? So let's talk about understanding mortgage maturity. So mortgage maturity is defined as the date when the loan term ends, and the borrower must either pay off, renew, or refinance the mortgage, okay? So, of course, we mentioned this last episode on our definitions of mortgage lending and private lending. This differs from amortization, of course. Private mortgages typically have shorter terms, as mentioned, 6 months to up to 24 months for some lenders, with interest-only payments. So there's no amortization in that situation, whereas amortization on traditional loans is usually somewhere in the 25 to 30-year range. The mortgage maturity, of course, is when the term of your loan expires. So oftentimes, traditionally in Canada, that's been around the 5-year term range. More recently, it's been around the 3-year term range. And as mentioned, shorter terms on the private side, typically 6 to 12 months with Keystone at least. So very important to prepare for the maturity well in advance. So, you don't want to leave this till the last minute, till a couple days before maturity to start attacking it. You want to reach out to your broker well in advance and get in touch with them. Or if you're the broker, you're going to want to proactively reach out to your client and talk to them, a month, 2 months, even 3 months before the maturity to talk about strategy. What's the next move here? How are we going to pay this loan out? How are we going to pay it down? How are we going to refinance this loan here? So sometimes, as mentioned in private loans, borrowers will need more time. And that could mean a matter of weeks. That could mean another full year, right? It differs case by case. So this could be due to, a refinance waiting to close. You could be simply waiting for your property to sell, or you could be even waiting on the buyers of your property for their financing to come through. There's a multitude of reasons why this could happen that would lead to potential requirements for an extension. Okay. So I'll walk you through today how to manage your portfolio when it comes to renewals or extensions and some different strategies to take care of there. So, of course, different options at maturity. Let's dive into that. So, of course, renewal, maybe the first one that comes to mind, maybe the most traditional way to look at things, maybe the simplest way to attack things if there's no other options out there. So the lender may offer or negotiate new terms with the borrower. So maybe rates in the markets have fluctuated over the term of that loan and you're in a new position, whether that's a cheaper rate or a higher rate, depending on the situation. And there could be new terms for that potential borrower as well, depending on the situation. Factors that could affect it, of course, your payment history, very important here. The value of your property. Has your property value fluctuated during the term? What are the market conditions in your given market? Have things gone up a ton? Is there a lot more equity in your property? Or has the market cooled and gone down in average value? And that can negatively impact what you could get in a potential renewal. and of course, the borrower's financial situation. There may be some underwriting required at the renewal period as well, depending on that situation. Of course, other things to consider, there could be fees at renewal and potential rate changes, as I mentioned, and specific to private lending. Every lender is likely going to have different nuances with this, but you can expect most likely that you're going to either see an increase in rate or an additional fee at renewal. But there is flexibility there, as we'll get into as well. So, as mentioned before, this presents a great opportunity for the borrower or their broker to discuss the plan with the broker. Okay. So, do you only need 1 month extension? Okay. So, chances are, if that's the case, the lender's probably going to be much more flexible with their fee if you're talking on the private lending side, right? So, if that lender offers a 3 month renewal to you and you only need one or less than one, maybe they offer you a prorated fee. Or if it's a full 12-month extension and you only need a couple weeks, chances are, maybe they're even gonna waive that for you, right? But if you do require that longer term, maybe you do require a full year for whatever reason, just something changed in your life, or you had a hiccup in your employment, or it could be a multitude of reasons, a change in a family situation, right? The lender may want to do a full underwrite of that file just to confirm that you're in a position to fully service that loan over that full year. And then you're likely going to, on the private side, have an additional fee, right? So if you paid a fee of 2-3% for that first year, chances are the renewal fee, if it's 12 months, is going to replicate that amount. So some private lenders, and this is something to watch out for as well, some private lenders choose to actually enforce immediately at renewal. Keystone does not do this, nor do we recommend this approach for that matter. But it's very important to look at this when you are selecting that private lender, because you may have some private lender that comes in and offers you, a cheaper rate or a cheaper fee, but maybe you didn't read all that fine print that's in there, all the legal terminology that's in there on how they can handle things at renewal. And, any good lender is going to have protections for them there, at renewal. If you haven't been making your payments, chances are you're not going to get offered that same renewal. But, I can speak to a personal account here. I've heard of some, I'll call them individual private lenders, I guess, who are, just maybe managing their own money. Maybe they have $1 million or $2 outstanding out there. So they're doing, call it anywhere from 5 to 10 loans at any given time. But, with maybe a smaller pool of capital available there, it's more important for them to get those funds returned to them at maturity, or they're more so depending on it. And that could be because they need those funds back for another investment, or maybe they have another funding coming up that they've committed to and they need those funds back, right? So there's nothing wrong with this. It's just something to consider that, if that renewal is not even going to be an option there, you're really going to want to understand that. And really understand, is it worth that maybe, cheaper half point or point that you might get to not have that security of knowing that the renewal could be there for you. So we've actually, at Keystone, we prefer, and in fact, we intentionally don't pay out other private lenders. There's a variety of reasons for this, but typically, if it's going from one private lender to the next, chances are there's some issues there, and the client's not really making any progress, right? You're in an interest-only loan, and you're bouncing to another private lender, paying a fee again, and then you're not really making any progress towards, the long-term strategy of getting you into a lower rate and longer-term loan. But in this scenario where it's actually an individual private lender, we'd probably look at that differently, right? Because if that lender is simply enforcing on that at renewal because they need their money back for another situation, we may look at that a bit more favorably and make an exception on something like that, especially if there's sufficient equity there and the client's following the right steps to be able to get out, and maybe they'll only need that for a couple more months before they're able to refinance. And I'll also point out from the borrower's perspective too, like, for example, say you're a real estate investor and the lender does enforce on you because you went, 2 weeks or 1 month past maturity. The odds of you coming back to that private lender for future deals is essentially nil. There's no chance you're going to go back to them for that next deal. So, something to consider again, even for, lenders listening here, if you're an individual, you may want to consider being a bit more flexible in terms of the payout, because, in most situations that I've heard of, if you have no flexibility as a lender, on the alternative side, you're either not going to last long or you're not going to have a great name in the industry, and it's going to be tough for you to pull those strong deals in for the foreseeable future. Okay, so moving past renewals here, refinancing with another lender, another popular method at maturity. Okay. So if the borrower is looking for better terms, who doesn't? They can seek financing from another lender. That could be an A lender, that could be a B lender, and I said in some situations that could be another private lender. Of course, it could be credit union, other financial institutions as well. Mentioned this already, but I'm going to reinforce it again. There's a key importance here of starting the refinance process early. It takes time. It takes time to go through this, right? At least 30 days, ideally 60 to 90 days before maturity. Get that ball rolling so you can maximize the potential options you have and get yourself the best possible terms. Okay. There's of course additional costs to consider here with a refinance. There'd be legal fees, potential broker fees, and potential payout penalties too. Depending, if you're in an open loan, you don't have to worry about that. If you're in a closed term loan, you got to worry about that as well, and want to make sure you have clarity on what those payout penalties are going to be. That's why it's always good, if you're looking 60 days out for that refinance, get the payout statement from your current lender and understand exactly what your costs are going to be to pay that out to ensure you can get that full amount covered with that refinance. Okay. Beyond that, of course, there's always the option for full repayment. Borrowers who have access to capital, that could be, sale proceeds from a property, that could be your own savings or investments or other financing that can pay off the loan in full. Okay. So as mentioned, some private lenders offer open terms, but many do not. Again, so interest penalties and discharge fees do need to be considered for the full repayment as well. Okay. And last but not least, going down a more negative path of potential defaults, right? So, and this is kind of worst case scenario, most lenders do not want to deal with this scenario, especially on the private side. This is, not the business we're in. We want to cycle through loans. We want to see our clients be successful and move on and refinance or sell that property. So if the borrower cannot pay or renew, the lender may have to start enforcement actions, right? So this would be, maybe in a scenario, say the borrower, had missed 3 payments and then wasn't responsive to any calls or emails, that borrower is not getting a renewal. Chances are the lender's already tried to be flexible by reaching out and understanding the story and trying to come up with a payment plan. But if you're non-responsive, chances are you're not going to get a renewal and the enforcement process will likely start at that point, right? The potential consequences of that could be anything from a demand letter coming from the lawyer, legal fees racking up, late fees racking up. A multitude of different fees could occur in that scenario, depending on how the lender's commitment is laid out. And of course, that could lead to power of sale or foreclosure of the property if a solution isn't found in the short term. So, from our perspective, a good private lender will have a professional lawyer to ensure they're well protected in the event of default. Okay. So with fees being applied at their choosing, and they can lay that out in many different ways. There could be, a default fee of, call it $5,000 or something like that. And that could be enacted based on a choice by the private lender. Chances are if that borrower is being a good communicator and helping the lender understand what the plan is to get current on that loan, that's not going to be enacted. But if the client's unresponsive, not communicating at all with the lender will have that option. And good private lenders have those lawyers, have those clauses in there to protect themselves, to ensure their investor capital is secure in the long term. Okay. And again, I'll continue reinforcing this. I think this is the most important takeaway. Proactive communication with the lender can prevent those legal actions. Okay. We've had many borrowers who come to us and say they need days or they need a few weeks to complete a refinance. And we waived all fees in that scenario, right? Even up to a month after maturity. If we know that's coming, if we know the ball's rolling, the broker's being communicative with us, the borrower's on board, it's just a matter of a delay at the new financing institution. We'll be flexible with that, right? So that's something to keep in touch as well. And I know it's a shame Neil's not here today because I wanted to touch on an example he's had with one of his properties. And I know he had a property that he was renovating with a private lender, a multi-unit property, and he completed it and he was all set to go for CMHC financing. And unfortunately, and I'll get Neil to speak in more detail to this on a future episode, but unfortunately there was an environmental issue with the property due to some old oil that was on the property. But fortunately for Neil, he had a good relationship with the lender, and he stayed, he was proactively communicating with them and saying, here's the situation, I'm doing everything, I'm following all the steps I need to ensure, this is going to reach a successful refinance at some point here, but I need a little bit of time. So, and I think, of course, he probably still faced those, rate hikes or fees that were applied additionally there, but that lender stayed on board with him, right? And they understood the story, and they stayed on board with him until he was able to get that finally cleaned up and then refinanced out. So just to summarize this episode here, always review your mortgage terms well before maturity. Work with your broker to explore renewal or refinance options early as well. Maintain that good communication with the lender to avoid any last-minute complications. And consider all your exit strategies when entering a private mortgage to prevent those issues at maturity. Okay? So, and you know what? The key takeaway here today, private loans are intended to be short-term. Both the lender and borrower have the incentive to get out of that loan on or before maturity, right? So that being said, things always happen, and this isn't always a reality. So, and we understand that as well. So, but when it does, we'll typically charge those extension fees, but this is always going to be flexible and always going to be on a case-by-case basis with depending on the borrower situation. So again, just to summarize, encourage borrowers and brokers to stay proactive in managing mortgage maturity, especially on the private side. And appreciate you all listening today. Please do subscribe, give us a 5-star review, and reach out if you got any topic suggestions for us in the future. Thanks everybody for listening. Cheers.
Thanks for listening, guys. It's Neil, your co-host and co-founder at Keystone Mortgage Investment Corp and Director of Investor Relations. I'm also a real estate agent, real estate investor, and business owner.
And your co-host and co-founder of Keystone Mortgage Investment Corporation, Ryan McNeil. Keystone MIC is licensed under the Mortgage Regulations Act of Nova Scotia, license number 3000844, and through FCMB, license 89280. Keep in mind, the views of this podcast are for informational purposes only and are not financial advice.